In this video, we will be knowing about the Dupont analysis. So, Dupont analysis is also one of the way wherein an investor can actually know about the fundamentals of the company before they are investing into their shares or any kind of investment that they wanted to make in that particular company. So what does it do? How, why there is so hype about DuPont analysis, and how do we understand? We will be taking the real practical examples to know it better. So without further ado, let's start with DuPont analysis. So before understanding about DuPont analysis, we have to understand uh, few elements which are very crucial to understand the DuPont analysis. So if I talk about normal sense that what is DuPont analysis? So DuPont analysis is nothing but how you are breaking the return of equity of a company in order to understand it better. Just to be very precise. So let's understand what are the elements which are involved in the DuPont analysis before jumping into the main topic. So what first we have is return on equity. Let's understand how everything works. So if a company wants to procure funds, why company procure funds? Because they have fixed term requirements and working capital requirements. Fixed term requirements means the company wants to procure land, building, machinery. For that, they require money. So that money which is required for that, that goes under the fixed term capital requirement. I have explained it in the previous videos of mine. And the working capital requirement, the day-to-day expenses that you need, raw material, wages, salary, rent, etc. So for that, for these two reasons, the company or a factory requires a lot of money. Now to procure that funds, they have two choices. Actually, they have three choices, but let's understand two choices for now. The first is through equity, that is the owner's fund, and the second is the borrowed fund, that is debt or loan or debentures, etc. So ownership means that they are diluting their ownership. So suppose I have a company, I have 100% stakes on it, but I want money. So I sell my 5% of ownership to a person who is willing to invest X and X amount of sum into my company, and in return of that they will get the 5% share of my company and I get the 95% share. That means for 5% I have actually diluted my ownership. This is one of the way. What in return they will get the increments, like not increment, but they will get uh, you can say like a interest they will get, okay, on the equity part that they have invested. That is nothing but return on equity. If I am investing into that business, I expect something in return, right? So that is nothing but whatever money I am investing in form of that ownership fund, uh, whatever return I have is nothing but my return on equity. So I have, this is one ownership example. The second thing is that the borrowed fund, which is nothing but debt. You give debt to someone and then on return they will give you interest. Simple. All right. But for now we are focusing on return on equity, because when we talk about DuPont analysis, it means how you're breaking your return on equity to understand the framework or the foundational fundamentals of the company better. So let's understand the return on equity part. So suppose you and your friend starts momos business, okay, and both of you invested 1,000 each to buy raw material like flour, vegetables, oil, etc. Okay. Now at the end of the day, suppose you made a net profit of 700 rupees. Now if you wanted to calculate what is your return on equity, is 700 divided by 1,000, which you have, 700 is the net profit, divided by the investment you have done, will be your return on equity. That means if we take this example, 700, which is the net profit, divided by 1,000, which was actually invested in the start of the day, will give you 70%. Now this 70% means for every 1 rupees invested, you have earned 70 paisa. In simple words, for every 100 rupees you invested, you have earned 70 rupees as profit. Simple. Okay. So this is the concept of the return on equity with a simpler example. Now let's have a practical example. So in this example, if you see, I have taken the real net profits of TCS, Tata Consultancy Services, for FY 2025. So that stands around 48,553 crores. Now, if you wanted to even check, you can check. It's available in the open forum. You can check. These informations are readily available. Now, net profit, you got to know. Shareholders fund. So what a shareholder fund means, that as per their balance sheet, what is the shareholder fund as per March 2025? That stands for 96,882 crores, which is nothing but equity share capital, the equity share the company has issued, plus the reserve that they have created. So company create a lot of reserves in order to meet their unforeseen circumstances, like paying off the debentures, loan, etc. I'm just talking normally. So this type of reserve the company created, it is also a part of ownership fund only. So that's why we club it with the equity share capital to understand the purview of shareholder fund better. So which stands around 96,882 crores. Now, if I wanted to check the return on equity here, which will be net profit divided by shareholders fund, which gives me for this like 50% around. That means for every 1 rupees which the owner has invested, they have earned 50 paisa on it as a profit. As a profit, that is a return. So if I am investing 1 rupees, I'm getting 50 paisa as a profit. That 1 rupees is staying there because I have the shareholder certificate. That is fine. I can dilute it whenever I wanted to. But what I am getting above on that is my return on equity. Here, this is the example. Now, what second thing is the return on asset. So return on equity is one of the major part that we learn on under the Dupont analysis. But we have another thing which is return on asset. So what is asset? Let's understand this first. So in commerce there are concept of asset. Asset means anything which is valuable, which holds some value. For example, if you are talking about the business of factory purview, whatever land, building, money, bank, money at bank, anything which has a value is your asset. Okay. Now, when you invest, suppose if I'm investing in a company, that company becomes, that shareholder certificate becomes an asset for me, and whatever I am getting as a return on it becomes my return on asset. Just an example. But if I talk about different way, like if I'm installing a machinery, I expect some return from it, that it will produce this and much of goods, and against that I will be getting a sum of money. Nothing, that's nothing but the return on asset. Now let's understand with the same example that we had, which is we have that momos business. Okay, so we have expanded our momos business and bought a cart. Now we also bought some utensils, etc. Now we have invested in a total asset of 1500 rupees. Now our net profit is 800 rupees. If I wanted to understand what would be my return on asset, is the net profit I have earned divided by the total asset. Here in this case would be 53.3. That means for every 1 rupees of a business owns, we make 0.53 as profit. That means every 1 rupees of asset which is invested, I am earning 0.53 profit on it. Simple. Let's understand with a practical example. The net profit of TCS for FI 2025 is 48,553 crores. The shareholder funds as of March is 1,59,629. I'm sorry, this is not shareholder fund, this is asset. There is some mistake in typing. So this is not shareholder fund, this is actually the total assets of the TCS as on March 2025, which stands for 1,59,629 crores. So if I wanted to understand that the profit that I have earned by using those assets will be the net profit divided by the total asset, which is 30.41. That means around 30 paisa. That means TCS is making 30 paisa profit per every 1 rupees it owns as an asset. Every 1 rupees of value of asset of under above which they are earning 0.30 of profit. This is the practical example that we are taking. Now, the another thing is moat. We also do moat analysis, but this is a small concept that we have to understand in order to build our foundation better for understanding the Dupont analysis. So moat means a company's special power that helps it stay ahead of others. I give you an example. If I take a phone of a company like Apple, which has a very big good value, now since it has a good value, it will have a moat on a different brands, like pricing power. It can charge extra than others because it has a moat. That is the goodwill or the pricing power. This is one of the moat. For example, cigarettes. So for cigarettes, the pricing power is moat. The company can increase the price of cigarette, but still the demand will remain the same. This is the pricing power. So cigarette becomes moat. Operating efficiency like DMart. So DMart has a legacy of having an operating efficiency. So it's a moat for them. Tata has a legacy of business, so it's a moat for them. So moat can be of a different type, in a goodwill, in a pricing power, in a operating efficiency, of a legacy of a business, which makes you stand out, your product or your company stand out from others. Okay, so we have understand the concept of moat. Now let's understand. We have understand ROE, ROA, and moat. But what does DuPont analysis do actually? So Dupro's analysis help us to find out why ROE is or ROA is higher or low. See, everything revolves around ROE and ROA. Whatever money you are investing, whatever return against that you expect to is ROE only. If I'm investing in a Lenskart IPO, whatever return I get, that is my ROE. And for that, I have to read company's fundamental to understand whether this company is investable or not. So for that, it helps us. Now it is, if it is high, if it is low, then how do we understand that, is it better or not? Okay, so why it will let us know whether why it is high or why it is low. So it breaks the big numbers, which is ROE, into small parts. So we can see, is profit low because of low margins, or because we use less assets, or because we don't even take loan, that's why our profits are high. So let me give you an example. This financial year I have taken loan. So when I take loan, it increases my cash flow. If it increases my cash flow, it also shows a higher profit ratio as well. So is it because of we are taking loans or not taking loans, or is it because we are using less assets or more assets? It DuPont analysis help us, because see, if a company has taken loans, and you see, and because of which their cash flow and cash inflow is has actually increased. If the company is inviting you to invest, you will see, okay, cash flow is good, the company won't go bankrupt, so you just directly invest. But would that invest be a sane decision? Because you are just investing by looking at, okay, the cash flows are good, but that cash flow is standing on the foundations of a loan. And if the company does not pay that loan, because if the company fundamentals are not good, the company will go bankrupt and your money will also go bankrupt. So that is why we have to understand why the profit is low or high. Is it for what reason? For using less assets or more assets, or is it because of whether the company is taking loan or not? So this is what the DuPont analysis helps us. Let us understand with an example. Before that, let's understand. So what ROE does, it breaks into three parts. It breaks ROE into three parts. So ROE is nothing but net income divided by shareholders fund, as we understand the first momos wala example. Now what the DuPont analysis does is, it breaks ROE into three parts: the net margin, the asset turnover ratio, and financial leverage. I have just made one video on leverages, operating and financial leverage. You can just look into my previous videos to check out. But financial leverage is nothing but when you use debt, it gives you a leverage. So using more debt above ownership is nothing but financial leverage. For now, you just understand like this way. So for net margin, we understand that how much we are earning income over our particular sales. How much the company is investing on that, how much they are earning income. Now income is earned through sales, and sale happens when there is a production, and production happens where there is money, and money is invested by the shareholders or the owners, and against which they get ROE. So everything is interconnected. So to understand ROE, the breakage of its three parts. The first is the net margin, which is nothing but net income above sales. It tells about your pricing power actually. Second is the asset turnover ratio. Asset turnover ratio is nothing but sales divided by total assets. It means that number of assets that you are using, how much for 1 rupees asset invested, how much sales it is giving you. It shows your operating efficiency. Now, financial leverage is nothing but how much total asset is there above your total equity. That means how well you are utilizing your equity money, or how well you are multiplying your equity for against your total assets. Now, when we talk about net margin, if the net income is high but sales is still low, that means the pricing power is high. If net income is low but the sale is very high, that means the pricing power is low. Understand? Because if my sale is very low but my net income is very high, that means I am playing the pricing power game. Like a case of example, Apple. Very, it can have a less sales with respect to other companies, the mid-range phones, but since they have the pricing power, their net income is high, so they are interconnected. Same sales above total asset. If the per 1 rupees invested in a total asset, it's giving you more sales. It shows that your operating efficiency is good. The production of your machine, which is invested as a total asset, is giving more result, and it's getting more sell out, and that's why the asset turnover ratio is high. Suppose 1 rupees invested in a particular total asset like machinery, it is giving you 2 units of products, and the 2 units gets sold out. So 2 divided by 1, your turnover ratio is 2. But using that same 1 rupees of total asset gives you 3 units now. That means your total asset turnover becomes 3 now. That means it is higher. So how efficient your operations are is what it shows you under asset turnover ratio. Financial leverage, I already explained you that how we are multiplying the equity against the asset of the company. So these are the 3 ways. So I will explain you with an example now. So this is an example of a DMart. So if you see, it's a return on equity that we have, and we have a Dupont equation as well. We will understand what it says. So see here, net profit margin, asset turnover ratio, equity multiplier. These are the 3. So here we have ROE. This ROE, to explain it better, the fundamentals of the company, it is divided into 3 parts, which is this equation, which we have already understood. Now see, return on asset, if you see 17, 18, 19, 20, 21, 20, 23, these are the years, FY 17, 18, 19 to 23. If you see here very closely, the return on asset is actually increasing 10.73, 14.6. It's keeping, there is a down, but it's increasing. There was a downfall, but again it increased. So if we understand why there was a now see, it could be ROA as well and ROE as well when we are understanding the Dupont analysis. So it can be breakage of ROA as well and ROE as well. So here we are understanding the example of ROA. So if you see, it's increasing. Now what is the reason of this increase? We have to understand. So if you see the net profit margins, net profit divided by revenue, I just showed you this example. This net profit margins are also increasing. Okay. Now what does it means? That whatever revenue you are earning, I am earning 100 rupees, but that 100 rupees also have a cost: raw material, salaries, wages, rent, electricity, etc. After deducting all the cost, whatever is left is your net profit. Okay. So and net profit margin means that what is the percentage of it that you are earning. So if you see, it is increasing. Okay. Then we have seen asset turnover ratio is also constant. Fine, we have already understand about this. And if we see return on assets, which is A multiply B, then we are also seeing an increase, because that's why ROA is increasing. Now we got to know that ROA has increased. Fine, this calculation is also here. But the reason for increase in ROA here is due to increase in margin while operating efficiency is constant. Now here the moat is increase in profit with the same asset base. Moat is nothing, it's acts as a cherry on top. We got to know that in this DMart case, the return on asset is increasing because there is an increase in the profit margin. Whatever company is selling out, the margins are getting higher. That could be because of good operating efficiency, or maybe because of higher prices but lower cost. Anything could be there, but we have an example wherein the net profits are increasing, which is good. Margins are increasing, which is good. Now we also got to know this margins are not because of taking loans, because the asset turnover, total asset turnover ratio is constant. That means it's not like they're just buying money and investing into assets. That's why it is getting increasing. So we got to know, okay, so asset turnover is constant. That means they are not taking loans, because loans is actually a liability, but you buy assets from it. So your asset turnover ratio also gets fluctuate, but it's constant. That means it's not the case. But the not profit margins are again increasing using the same asset base, which means here the return on assets are increasing with the increase in margin while the operating efficiency remains the constant. Here, what is the best thing is that increase in profit is there with the same asset base. So this is one of the mode that we have. So if I wanted to invest in this company, I will definitely go invest because the profits are increasing, not with any red flags, but operating efficiency is same, but still they are able to earn this much money, which is a moat. Moat means why it is better than others, because here the operating efficiency is same, but still they are able to increase their net profit margins. This is how the Dupont analysis help us to break the ROA or ROE to understand better whether we should invest or not. Okay, second guys. All right, that's all. This was a video for today, and we'll bring more video as such. I hope you like this video. This was the DuPont analysis, and DuPont analysis can be used in many ways. I showed you RO example, but ROE as well. And this is one of the way through which an investor can choose. I also have made videos like technical analysis, fundamental analysis. This is one of the way wherein we can have a deep dive before we are investing in any business. Thank you so much for watching this video, and I will see you in the next one.